Welcome to our weekly recap edition of Crypto Macro Insights. I'm Maya, and it's Saturday, August 30th, 2025. Tom, what a week this has been. We've witnessed one of the most dramatic shifts in both market conditions and sentiment that I can remember. Let's walk our listeners through what happened from Monday's nervous optimism all the way to Friday's complete retail breakdown. Where do we even begin?
Maya, this has been the most extraordinary week I've analyzed in years. We started Monday with Bitcoin consolidating around 113K and cautious optimism about rate cuts. And we're ending Friday with Bitcoin at 112K, but with retail sentiment in complete psychological collapse. The paradox is stunning. While retail investors are literally discussing suicide and fleeing countries due to criminal targeting, the macro backdrop has become the most Bitcoin-bullish setup in modern history. The reverse repo facility has essentially evaporated, unleashing nearly $200 billion in fresh liquidity into the system.
Let's start with Monday, August 25th. We discussed how community sentiment had shifted from cautious optimism to growing September fears. Bitcoin was around $113,400, and you mentioned the reverse repo facility was already showing signs of collapse. What were the key themes from that discussion?
Monday was the inflection point, Maya. We had reverse repos at around 126 billion, down 50% from February peaks, and I was tracking the college selling pressure narrative that was starting to spread. The key insight was recognizing that seasonal fears were mixing with legitimate structural changes in liquidity. I assigned a 35% probability to the bull case, 45% to range trading, and 20% to bears. What's fascinating looking back is that the macro data was already screaming bullish, but retail psychology was starting to crack under September fears.
Then Tuesday saw this dramatic acceleration. By Tuesday, you called it the liquidity paradox as sentiment collapsed while macro conditions improved even more. Can you walk us through what changed so rapidly?
The speed of the psychological shift was unprecedented, Maya. Monday brought posts like, "Bull runs over, pack your bags," and by Tuesday, we were seeing reverse repos collapse to 47.57 billion, a 62% decline in 6 months representing 60 billion in fresh liquidity. But the real shock was the community sentiment going from concern to genuine panic. People discussing getting liquidated multiple times in single nights, talking about selling portfolios for college expenses, and this widespread feeling that retail was gone and not coming back. I increased my bull case probability to 40% because this felt like textbook capitulation.
Wednesday's episode was titled The Great Liquidity Flood as the reverse repo facility hit rock bottom at 28.57 billion. This was also when we started seeing some truly disturbing sentiment indicators. What stood out most from that day?
Wednesday was when the data became truly extraordinary, Maya. The reverse repo collapse to just 28.57 billion meant roughly $150 billion had been injected into the financial system in 6 months, more money than most major cryptocurrencies' entire market caps. But what was most striking was the bifurcation in retail sentiment. On one side, we had people discussing literal suicide after multiple liquidations. On the other, Bitcoin maximalists advocating for 95% expense cuts and living on rice and beans to accumulate more. This extreme polarization typically signals major market inflection points. I pushed my bull case to 45% because the setup was becoming textbook contrarian.
Thursday brought reports that were genuinely alarming: organized crime targeting crypto holders in Bulgaria. This moved beyond financial markets into real-world safety concerns. How did this fit into your overall thesis?
The Bulgarian situation was actually a perverse confirmation of the thesis, Maya. When criminal organizations start targeting crypto holders using tax authority databases, it means crypto has reached critical mass where it matters to both governments and criminals. Short-term, it creates maximum fear, people literally fleeing countries for safety. But long-term, it validates Bitcoin's value proposition. If people risk murder charges to steal it, it's clearly valuable. This pushed retail sentiment beyond financial fear into existential terror, which historically marks important bottoms. I increased conviction to 50% bull case because the macro setup with 200 billion in liquidity was meeting maximum psychological pressure.
Then Friday brought us to the final escalation. The liquidity wave peaks with reverse repos at just 31.97 billion, down 86.4% in 6 months. You called it potentially the final moment before the most asymmetric trade opportunity in Bitcoin's history. That's quite a statement. What made you so confident?
Friday crystallized everything, Maya. We had the convergence of multiple once-in-a-decade events. Nearly 200 billion in fresh liquidity flooding the system. Retail sentiment reaching genuine despair, with people expressing suicidal thoughts. The VIX at historic lows of 14.85 showing institutional calm, and the yield curve steepening to 0.6% signaling economic normalization rather than recession. Bitcoin's resilience at 112K despite maximum psychological pressure suggested smart money accumulation. I increased to 55% bull case conviction because if we get weak employment data September 4th to 5th and Bitcoin breaks 115K, we could see the most violent short squeeze in crypto history, but this time backed by institutional infrastructure and massive liquidity.
Let's summarize the key metrics that changed this week for our listeners. The numbers are quite staggering when you see them all together.
The metrics tell an incredible story, Maya. Reverse repos collapsed from around 126 billion Monday to 31.97 billion Friday. That's roughly 94 billion in liquidity injected in just 5 days. The VIX compressed from 16.6 to 14.85, showing institutions getting more confident, not less. The 10-year minus 2-year yield spread steepened to 0.6%, up 140% in 6 months. The dollar index weakened to 120.70. Real yields fell to 1.87%. Every single macro indicator became more Bitcoin-bullish, while retail sentiment moved from concern to complete despair. That's the perfect contrarian setup, maximum support meeting maximum pessimism.
Despite all this drama in sentiment and macro conditions, Bitcoin itself held remarkably steady. It started the week around 113,400 and ended around 112,000. That stability amid such extreme conditions seems significant.
That stability is perhaps the most bullish signal of all, Maya. When retail is literally discussing suicide, fleeing countries, getting liquidated repeatedly, and criminal organizations are targeting holders, yet Bitcoin barely budged from its range. That suggests massive smart money accumulation. Institutions and whales are absorbing all this retail selling pressure, while retail focuses on meme rotations and panic. This kind of price resilience during maximum psychological pressure typically precedes explosive moves higher. The fact that 200 billion in fresh liquidity couldn't even push Bitcoin meaningfully lower despite maximum retail capitulation tells you everything about underlying demand.
Looking ahead, you've consistently pointed to September 4th and 5th as the critical catalyst dates with the employment data. As we head into next week, how should our listeners be thinking about positioning and risk management?
The setup has never been more compelling, Maya, but it demands extreme discipline. With 55% bull case conviction, I recommend modest positioning ahead of the employment data, maximum 3 to 5% of capital in Bitcoin positions. The key trigger remains weak employment data on September 4th to 5th combined with Bitcoin breaking and holding above 115K. If both occur, that's when you scale up aggressively, targeting 130K to 140K within 2 to 3 weeks. But stops must be tight. Below 108K invalidates the institutional accumulation thesis. The biggest risk is emotional, watching potential gains evaporate if you're overleveraged. Remember, with 200 billion in liquidity and maximum retail capitulation, the move when it comes will be violent and fast. You don't need big size to benefit from asymmetric opportunities.
What about the bear case scenarios? What would completely invalidate this contrarian thesis that you've built up over the week?
Strong employment data on September 5th would completely flip the script, Maya. If we get robust job growth above expectations, especially combined with the dollar index surging above 125, that forces the Fed back into hawkish mode, and this massive liquidity gets drained quickly into bonds and dollars. In that scenario, I'd expect Bitcoin to test 95K to 100K fairly rapidly. The other invalidation signal would be if Bitcoin breaks below 108K before the employment data. That suggests the institutional accumulation thesis is wrong and smart money is actually distributing, not accumulating. Political instability could also disrupt everything. If we see major policy reversals or economic data integrity challenges that create broad uncertainty, even this bullish liquidity backdrop might not matter.
Tom, as we wrap up this extraordinary week's recap, if you had to give our listeners one key takeaway from these 5 days of dramatic developments, what would it be?
The key insight is that we've witnessed the convergence of multiple generational forces, Maya. Nearly $200 billion in fresh liquidity has flooded the system, while retail psychology has moved from concern to genuine existential terror. People discussing suicide, fleeing countries, and facing criminal targeting. Yet Bitcoin has held remarkably stable around 112K, suggesting massive institutional accumulation during maximum retail capitulation. This is the textbook definition of a contrarian setup. With employment data just days away on September 4th to 5th, we're approaching what could be the most asymmetric trade opportunity in Bitcoin's 16-year history. The convergence of maximum fear and maximum liquidity support rarely occurs, and when it does, the results can be explosive.
An incredible week of analysis and insights, Tom. To summarize this extraordinary week for our listeners, we witnessed the reverse repo facility collapse from $126 billion to $31.97 billion, unleashing nearly $200 billion in fresh liquidity. Retail sentiment deteriorated from Monday's nervous optimism to Friday's complete psychological breakdown, with reports of suicide ideation and criminal targeting. Yet Bitcoin held steady around 112K, suggesting institutional accumulation during maximum retail capitulation. The macro environment became increasingly Bitcoin-bullish with VIX compression, yield curve steepening, and dollar weakness. Tom's conviction increased from 35% to 55% bull case probability as the contrarian setup intensified. The critical catalyst remains September 4th to 5th employment data, with 115K as the key breakout level. This could be the most asymmetric opportunity in Bitcoin's history, maximum fear meeting maximum liquidity support. We'll be back Monday to track how this unprecedented setup evolves toward what could be the trade of the decade. Until then, stay disciplined, stay positioned for asymmetry, and remember, when everyone is prepared for disaster, markets often surprise to the upside.